All right, cool. So today's lecture, right, is the main point of this lecture is IPDA market structure. All right. And when we're talking about market structure, we're not talking about market structure from the scope of higher high, higher low, so on and so forth, right? Because as mentioned, we understand that it's a lot deeper than that. The algorithm is not just creating higher highs and higher lows just because it's remembering a previous higher low, or it's not saying, hey, now let me make another higher high because I've just previously made a higher low. All right. Um, so the contents of today's lecture, right? We'll talk about the two signatures in price, failure swing, and breaker. And I will say this, right? Don't take this lecture as I already know what a breaker is or a failure swing is. So I'm not going to really pay attention to this lecture, right? Obviously, some of us are already well versed in that area of price. Some may not be. However, the main point is this is for more refined understanding. All right. It's not just to give you the term. We'll take a look at the anatomy of the swing high and low, understanding how to kind of process short-term highs, intermediate-term highs and lows, and things of that sort. We'll look at high and low resistant liquidity runs, and then just a small side note on that in terms of news's influence on that. We actually saw that last week with CPI. We'll look at SMT, and then we'll have a little bonus piece towards the end, which is in regards to when we say time delivers price. So for you guys that trade indices, that will be pretty sweet to actually see that. All right. So once again, why this lesson, right? This lesson is aimed at shifting the trader from the subjective traditional view point of market structure, right, into understanding market structure from a sequential standpoint. All right. So if the market structure is defined as a series of necessary events that occur as price delivers from one turning point to another, or we can say from PD array to PD array. All right. All right. So cool. The two signatures in price. As traders, all right, we are typically only concerned with the actual turning points of price. All right. And so it is very important that we kind of center our focus and understand there's only ever two signatures. All right. So if you go into price understanding that, like, hey, this is a key level. At this key level, once I zoom into a lower time frame, there's only two signatures that can form. All right. There are no other two signatures outside of those two signatures in price. All right. Let me let this go. All right. There are no other two signatures. So as traders, we care about this point, this point, this point, this point. All right. And we have to entrust, right, or refine our focus to understand that price is ever only going to do this, failure swing or breaker. Once again, down here, failure swing or breaker. So on and so forth, failure swing, breaker, right? And then we'll go failure swing here. All right. Just very slight depictions here, but we'll go more in depth in terms of what each one is, right? Over here, we're seeing that price is running up, down, up, right? Obviously, that's our failure swing. And then here we create a short-term low. We run that short-term low, displace back beyond it. And then now we're seeing that area play out as a breaker. Okay. So let's focus first on the failure swing. All right. Now, once again, the failure swing is we're seeing price rally up, right? Trades off of that high, and we try to make an additional rally. That rally fails, and then we see displacement beyond this point. All right, now key point. It is not a failure swing until price displaces beyond this point here. Actually, let me draw that with another color. All right, it's not a failure swing until we displace beyond that point. Okay. And you want to see some type of displacement beyond that point. It kind of goes back to what we were talking about last week and understand efficiently traded price ranges and things of that sort. This is going to be like if you just consider this point in price, right? That's a range. We want to see price leave that with speed. All right. Now, once again, technically speaking, trading through that point makes it a failure swing, but we want to see displacement. Okay. Remember, when the breaker or the mitigation block, which we're going to talk about when those are accompanied with an inefficiency, right, it heightens the probabilities of that area becoming a catalyst for price. Okay. So once again, rally higher. All right. And obviously, we want to see this rally into an array. All right. We come off of that high. We start trading back higher. We fail to make it back above this high. And then we displace lower. All right. Now, the failure swing, right? This is that low resistance signature. All right. Low resistant. All right. Low resistant because if you think about it, right, this is what we kind of reference as layered liquidity. All right. So price hasn't technically run any stops. So the look back function, right, because we know that price is trading from discount to premium, premium to discount. When price reaches this area here, obviously this is going to be a discount array that sells out liquidity. The look back function, right, is going to have a much easier time wanting to run back through that area. Okay. Now, in me saying that, that doesn't mean, hey, don't trade failure swings. A failure swing is actually, I prefer to see a failure swing. All right. But there's key points in terms of how we engage with this, and you're going to see why this is important once we start talking about swing highs and swing lows. All right. So that's our failure swing. Now, because the failure swing is a low resistance signature, actually, 1 point. So this is a high, right? Obviously, this would be the midpoint, and this is the lower high between those two highs. That candle, that rest here, this down close candle, right? And some of you may already understand this. That down close candle is our mitigation block. Right? That down close candle is our mitigation block. That's our reference point. All right. And like I tell you guys, I'm not a terminology guy, right? Regardless of what we call this, we can call it a rocket block. It doesn't matter. What matters is that point in price is a reference point. Okay. So that point in price becomes a reference point. Now, let's talk a bit about the failure swings. All right. So we'll provide a little example here. All right. So obviously this area, right? So that area of fair value, we're going to say there's an inefficiency within this area also. All right. When we think about our pricing sequence, we're seeing engineer, neutralize, distribute. So we're thinking rebalance, right? Redistribute. So when price reprices back up here, all right, we run into that array. We go here, here, and here, right? Are you guys taking that trade? So basically, we have a failure swing. We might have displaced past this point. We have our little mitigation block resting there. We've traded into the array. Are you guys taking this trade? And you guys can actually speak up and answer this. Are you taking this trade? Like once we trade back to this inefficiency, right? Because we traded into the array, right? Are you taking this trade? Yes or no?
Yes.
All right. So that's one yes. You guys can place it in the chat also. I actually want to see you guys' answers in terms of this. Okay. All right, Rory, I see you. Okay, cool. All right, David. Oh no. All right. Okay. All right, cool. Good job, Lee. All right. The answer to that, right, would be no. Now, the reason being is because if this is a low resistance signature, all right, and we understand that price has to continuously go through this. What is that high probability pricing sequence? I'm just going to write the abbreviations from last week. That high probability pricing sequence is engineer, neutralize, right? And I'm going to stop right there. All right. So if this is my high probability pricing sequence, if I don't have that, if I can't truthfully say prices engineer something, right? That means I cannot call this high probability, right? Immediately probabilities are lower. So if I'm entering here, if I'm looking to take this trade right now, I'm not allowing price to go through that sequence, that pricing sequence that I know is high probability. All right. And the second thing is, if this is a low resistance signature, right? If you're not allowing price to engineer and liquidate some type of buy or sell stops, then you're going to become the liquidity provider, right? For this trade. If you look at this range, all right, think about this range. This would be a liquidity void, right? There really are no swing points, right? This is basically, this delivery is one direction, meaning that especially within this range, price will need to engineer its own liquidity. Okay, so if you're taking this move, this is basically an inducement, right? This is just trapping anybody that wants to be in this move too soon and that's not willing to sit on their hands and allow price to go through that pricing sequence. All right, so we're not gonna, and this is, just remember this, right? This should be a keynote. Never take the very first swing into an array. And maybe I shouldn't say never, right? Because everything kind of has everything has there's going to be slightly different scenarios, and sometimes common sense will override rules. All right. However, we don't necessarily want to take that very first swing into an array, because there's a high likelihood that that first swing is just a short-term high. And we'll get into short-term highs and lows later. All right. So now we have price running back up here, right? You've taken that trade, you saw a fair value gap, structural shift, and you're getting taken out. All right. So now we run up here. Now we take out buy stops, and price may even form the same signature. Third swing. Boom. All right. We rally back up here. Now are you guys taking that trade? I'm going back to the chat. Yes, no, maybe so. Cool. I like it. Right? Why? Why are you guys now taking that trade? Why is it? Right, Jason, he still said no. Why are you guys taking that trade? All right, cool. Negate. Okay, I like that. I like that answer, David. All right. So that's a great point, David. Right? If it negates that inefficient, we're gonna talk about that as well. So price price is engineered, right? It's neutralized. We're at an area, right? If we're thinking from a fractal standpoint, we're at an area where we should be rebalancing from looking at the overall fractal. All right. And then we zoom into here and we're just looking for that delivery. So you guys are in the chat, you're saying trading the response. This is a means of a response. This is the array, right? I'm sure a lot of you, before joining or coming here, you probably see that market structural shift, take a limit order entry, and hope it works out, right? Now we're going to start practicing patience, understanding that price is going to go through a certain sequence before it turns around, and that is fractal. All right, so here's that third swing. We're not taking that very first swing into that array, low resistance signature. We run out that high, right? We form another failure swing. However, this failure swing happens to be created after taking out pre-existing liquidity. All right. So this trade in this case, without us going through an entry model or anything of that sort, this trade in this case would be much more, I'd be much more confident in taking that particular trade. All right. So that is our failure swing. That's how we want to engage with that failure swing. All right. Now the breaker. Obviously, let's say we have a short-term low, right? We run out that short-term low and we rally higher, taking out this short-term high, and then we displace back beyond that point. All right. Now the breaker, right, or we say a stop run and reversal, and then that creates the breaker. The breaker is a high resistance signature. All right. So notice the difference between the two. All right. So the breaker actually runs out the stops before the reversal. Comparison to the failure swing, stops are not run out. Right. So this becomes a high resistant. We'll just say high resistant liquidity signature. All right. And when we're saying high resistant, basically what we're saying is price is going to have a much harder time running back through that area. Why? Because liquidity was already swept. All right. So the breaker, actually, let's go back over here. All right. So the breaker or stop run and reversal is what we deem a high resistance signature. Right. It is a point in price where liquidity is run out and price usually provides an immediate rebalance. Key point right here. Right. Immediate rebalance. What I mean by immediate rebalance is, let's imagine we have somebody that's just joined. All right, let's imagine price is here. We create that low, we run that low, and then shortly after running that low, we immediately trade back in the range. All right, this is more characteristic of an opposing stop run. All right, so it all points back to how price leaves the range. All right, so an immediate rebalance is more characteristic of an opposing stop run, right? That opposing stop run meaning the stops at the opposite end of this little range here. All right. And once we see that displacement, remember that displacement is important. Once we see that displacement, that creates the breaker. All right. And then once again, the breaker becomes heightened in probability when accompanied with an inefficiency. All right. So if we take this little image here, kind of see that short-term low created, price rallies higher, take out that short-term low, and then we displace back above, right? So this point, that up close candle, that becomes our breaker. All right. That breaker is also accompanied with an imbalance. All right. So going back to our drawing and looking here, this candle, the candle that rests right here, right? That becomes our breaker. All right. So a breaker in this, I find that it's much better understood in this way. Consider a breaker what, like if you were to look at a chart and you were to see this and that, and then boom, what the very first thing you say about this down close candle is that that's an order block. You say that's a highly probable order block. Why? Because it took out liquidity and it rallied higher. All right. So breaker is nothing but a what used to be a highly probable order block, right? And where it basically it fails, right? Hence the term breaker, right? That area breaks. All right. Just to add a little more padded understanding, if there were a sense of buying pressure, consider that this would have been the start of that buying pressure. All right. Those guys start to buy up, net positive, price runs back lower. Now they're net negative. How do they mitigate those positions? They do so by exiting at this point, right? This would be technically the 0 point, right? Because that's where they initiated those positions. All right. So when price comes back up here, we're expecting that this area of price, especially if it's accompanied with an inefficiency, we expect that that area of price will hold. All right. And this understanding is also fractal. So also in looking at this whole breaker scenario, what is this? You guys can speak up. What is this right here? Like what is this delivery? From let's
Dealing range.
yeah, dealing range, right? It's as simple as that. It's a dealing range. All right. And when I'm looking at breakers, right, obviously, you know, the we can say, hey, this is a breaker, right? It price took out that low. When I'm looking at breakers, I like to see an actual short-term low created and then price running that low out and then going here. All right. Why? Because that used to be a highly probable OB. All right. So that's just one little, fine point for you guys to focus up on. So a few examples. This is from the previous few weeks. This is on Euro USD. We can look here. right? Running out that short-term low, and then boom, displacing higher, all right? So initially we say, hey, that's a highly probable order block. The price runs through that area, right? We go through that area. We have an inefficiency up here, but actually that's not an inefficiency. If we were to, it's a small inefficiency, but if we were to go to a lower time frame, we would see some form of imbalance within these candles. However, the delivery is what I want to show you guys here. This would be a breaker, all right, and then we continue lower, all right, and then also order flow, higher time frame order flow with this is actually bearish. Another example here, this is the bottom of the range for euro. Rally here, here's a short-term low. We're going lower, right? Price displaces higher. So we're taking that candle, right? And it's and another point. It's not just about this candle. It's about the entire delivery here. All right. This whole piece of delivery, right? Because if we were to zoom to a different time frame, we may see one candle with this whole up move. That whole move would be considered our breaker. All right. So in different scenarios, not even in different scenarios, as you just gain better understanding and you move from kind of like being a robot to just understanding what's going on, you'll know when you can just look at that candle or take the range. All right. However, we're seeing breaker accompanied with inefficiency, right? That area becomes a highly probable area. All right. Another example here, short-term low, right? I'm sorry, we'll go high. All right, we have short-term high. We run that level out. Down here, sweeping the lows, displacing beyond that point. All right, so now this becomes our breaker. Back into it, right? And then we get away. Same idea here, right? High resistance signature. Price trading back inside of the range. You can see here, this is a dealing range, right? Look at what price does once it gets inside of here. Boom. Comes here, here, engineers, neutralizes, distributes, rebalances, right? So you have basically dealing range inside of dealing range, because this becomes another dealing range. 1, 2, 3, right? Breaker. All right, same idea here. Breaker, you guys kind of get the point. This here, this area here, right? Just seeing it in a manner that's not so textbook, right? But understanding the details, right? Because you guys can see if initially this area almost held up or did hold up at one point in time as an order block, right? We push past that level, come back down into an inefficiency, and then we get away. All right. Few examples of the failure swing or the mitigation block. We can see here, creating that high, back lower, failing to run back above that high, displacement, right? There we go, back inside, and then boom. So that down close candle is our mitigation block. Another example here, failure swing, right? Mitigation block, down inside, getting away. All right, so I don't want to bore you guys to death with mitigation blocks and failure swings, but that is your mitigation block and your failure swing. All right. So moving on to if the market structure. All right. So if the market structure, once again, is a series of events that occurs as price moves from one turning point to another, or from PD array to PD array. All right. So if you think about, and the reason I'm giving you that definition is because when you think about delivery, all right, and price is basically there are turning points. All right, those turning points, price is not just turning around out of thin air. All right, it's turning around because at this point there's something to the left. All right, at this point there's something to the left. Right now, as price reaches into those areas, as we just saw with that the example that we use with the failure swing, when price reaches into these areas, right, structure is going to form as a result of that series of events that needs to occur, right? Because that's just how prices book. So as price is moving up here, it's going to engineer, right? It's engineering liquidity in the form of short-term highs, neutralizing, tapping into the array in the form of an intermediate term high, right? As David mentioned, maybe there's an imbalance that becomes negated right here, right? From lecture 1, we learned that when an imbalance is negated, for us, that's a market structural shift. All right. What happens? What usually occurs after a market structural shift? A retracement, right? Price is coming back up here, rebalancing that range, right? So this is structure. This is market structure. This is the structure as we know it. All right. This is the objective viewpoint of structure, of market structure. All right. So it's that engineer, neutralize, distribute, rebalancing, creating that other short-term high, right? And then redistribute. Now you see an entire swing high fractal. So let's this is kind of a real example of what we're mentioning here. So as a short-term high, price rallies higher, right? Taking out the array, down, negates the imbalance, creates the other short-term high, boom, right? This is our market structural shift, retracement, boom, right? This is a 1 minute time frame, but you're gonna see how that whole swing high, nature of that swing high is fractal. So let's talk about a swing high. So what is a swing high? All right, swing high consists of a high, right, in the form of a short-term high, a higher high, and a lower high. All right, so let's draw that out. So we're seeing a high, higher high, and lower high, right? In candle form, we draw high, higher high, and lower high. And once more, high, higher high, lower high. All right. Now, what we have to understand, right, and you guys should also see here, still pointing back to that dealing range type of scenario. But what we have to understand is this high, higher high, lower high, right? This is fractal. Okay. Within this, you're going to have a high, higher high, lower high here, right? Even inside of that, now I can't make the ballpoint of the pen smaller, but even inside of that, you're going to have the same fractals that are forming high, higher high, lower high, right? Or short-term high, intermediate, short-term, right? Same idea will occur here. Short-term, intermediate, short-term, right? Inside of each one of these, same idea. Here again, short-term, intermediate, short-term. This is nothing but engineer, neutralize, distribute, rebalance, redistribute. Okay. Now, when we're looking at price, obviously, this would be, if you think about price, this would be the array. All right. This overall, this very first swing, we see that as a short-term high, right? This next swing, we see it as an intermediate term high. Right. Now, to complete the swing high fractal, the next thing that we need is a short-term high. So you're already anticipating that short-term high. So let's talk about or give characteristics to each one of these short-term, intermediate, short-term from left to right. All right. So that very first short-term high or low, we'll just call it short-term. All right. its role or its job is primarily to engineer liquidity. All right, to engineer liquidity, and it typically crouches above or below an array. All right, we see the array here, short-term high or low, right? Maybe there's even a failure swing that forms inside of this, all right? And you're induced, right? Not really understanding to allow that fractal, that pricing sequence, all right? That's the short term. Now, intermediate, this is the higher low that typically neutralizes the liquidity from the short term and also engages with the array. All right. Now, does that mean that the short term high or low can't trade into the array? No, that doesn't mean that. Right. What it does mean is, hey, be very mindful about taking the very first swing point into the array. All right, because you can back test as much data as you want. What you'll find is that typically there's an array, price goes here, right? And you take that move, you're you're going to become the liquidity provider, right? And then you're going to see price run away. All right. So that intermediate, so we have short term, right? Typically engineers the liquidity and crouches above or below an array. And the intermediate term high, right, neutralizes liquidity from the short term, plus it engages with the array, right? One other additional point is when it comes to that intermediate term high, right? Whenever price rebalances an inefficiency, right? And let's say there's an inefficiency, there's a range, there's an inefficiency, right? And let's say there's a short-term high that rests before the inefficiency. In terms of rebalancing that inefficiency, right? We immediately see that as our intermediate term high. All right. Now, what does that mean beyond me just saying that? What that means is if I have an intermediate term high, what do I need to complete the swing high fractal? Can somebody answer that? All right. Let me check the chat. I know you guys are kind of shy. All right, cool. Good job. Right. To complete the swing high fractal, all right, we are going to be anticipating that other short term high to form, right? That is basically where price is rebalancing the range. All right. So that other short term high, remember, this is from left to right, right? This this is typically rebalancing the range. Right? As we look here, you can see that whole sequence. Does not matter what time frame this is. All right. And then we also have to understand that this is not just a blank space. There's trading being done within that area. Right? There's trading being done within this area also. All right. So, and obviously, right, we're not going to go completely through the whole swing low. It's just going to be the inverse of what we're talking about here. All right, so let's look, let's just take a look down here. All right, so we can see price pushing lower, right? Short-term lows are created, rallies higher, intermediate term low, right? And then there we go with another short-term low, right? Completing the swing low fractal. We can look here. There's an array, right? Very first swing point, short term, we create that intermediate, imbalances within this range are negated, all right? And we're anticipating that other short-term low, all right? Now, you have to understand these time frames are zoomed out, this is, you're seeing this on a higher time frame, right? And you're anticipating certain things. So if you think about Euro USD over these past 2 weeks, right, and me saying, hey, I'm anticipating a retracement because I'm starting to see that swing low scenario form. All right. What this lesson does is it helps you build those types of anticipatory skills. So then when I'm on a lower time frame, I can go inside a price and I know what I'm expecting on that lower time frame, or from an intraday perspective. And this also obviously occurs in a lower time frame as well, because this is a 3-minute chart. All right. You're seeing a short-term low created, right? Price running down, all right, creating that intermediate term low. All right. And then you can consider this the short-term low also. Doesn't really matter, right? Imbalances are negated. All right. And then the short-term low forms. Same idea here. Short-term high, intermediate, short-term. All right. Let's go to the euro and look at that price action from the past few weeks. All right. So we had this level. Obviously, we ran through. This is even better, actually. All right. So we had this level. All right, but obviously we have this level too, right? This is what I mean. That short-term low is hovering above this array. All right. But anyways, we run down, right? And yes, we're exhausting higher time frame levels. However, this is the very first swing. All right, if price is going to run higher, it's not just going to go higher from this swing point. It's going to engineer liquidity first. All right. So in seeing price run through this low, right? And now, yes, this is a daily time frame. This would be to some degree considered that immediate rebalancing, right? Trading back within that range. All right. Now I'm seeing, okay, cool. This is a short-term low. This is potentially an intermediate term low. So what do you think I'm looking for when I'm looking in this range? David, what am I looking for to kind of validate me saying, all right, this might actually be that short-term low? I mean that intermediate term low. I'm looking for that other short-term low to possibly trade back through the opposite end of that range. Like, what would I be looking for in here, David?
So I'd be looking for the price to negate the inefficiency.
Yeah, right. So inside of this range, right, we're looking for to kind of confirm that idea, right? And not so much as confirm 100%, but to validate that idea a little more, we'd be on that lower time frame, 4 hour, 1 hour, looking for an inefficiency such as this, right, to be negated, all right, and then we get this other short term low that formed. I think this was NFP, I believe. Yeah, this was NFP. And we had that other short-term low that formed, right? And then prices running through the opposite end of this range. All right. If we go down on a lower time frame, right, we'll see the same sequence. So basically, this is what we're seeing, right? When I'm drawing that depiction here, what we're now zoomed into, right? Because if this is short-term low, intermediate term low, short-term low, we have to understand that even inside of this intermediate term low, there's going to be a degree of short term, right? Because this whole thing is that intermediate term low when I was just zoomed out on the daily time frame. All right. So you have to come inside of this with the same anticipation of seeing price go through that pricing sequence. Short term, intermediate, right? Oh, we just created the other short term low. And then price begins to rally higher. All right. Every turning point in price, right? If you guys look at every turning point in price, okay, if you haven't focused on price from this perspective yet, all right, start looking at price from this angle. Because it's always every time price turns around, it's going to give you that degree of short-term high, intermediate, right? Oh, now anticipate the other short-term high. Well, guess what this move was? This was a Judas swing, right? Understanding what we should anticipate next, right? Short-term high crouches where? Below an array, hold high. Intermediate term high takes the array out. All right, what's my anticipation? Short-term high. Now I move into my intraday chart. All right, we're coming into intraday, understanding we're in a bearish market. We have a low resistance signature. All right, we're going to talk about when a high resistance signature is taken out. But we have a low resistance signature. I'm coming into my intraday chart, right? It's Monday, we're moving above the opening price, and I'm already anticipating that price is going to trade lower. All right, so I'm just looking for things to kind of validate that viewpoint. All right, this is that Judas swing, right? We run out stops, imbalances negated. We have a change in the state of delivery, right? We had some guys that actually took shorts and they were targeting the bottom end of this range. All right. Back here. All right. All right. So SMT, right? SMT is another part of the conversation of market structure. All right, so SMT or smart money tool is a term used to signify crack in correlation between two highly correlated assets. All right, those assets can be either positively correlated. Let me see something here. All right, those assets could be either positively correlated, right, or negatively correlated. All right, either way, we know that they have a high correlation. So because of that, what we're looking for is a crack in correlation. All right. And these cracks in correlation, right, are good practice. It's good to look for when price reaches into higher time frame levels. And we saw that last week. So moving forward, what you guys will hear me say a lot once we move into key levels, I'll always say things like looking for some type of crack in correlation at the previous day's highs or previous day's lows, right? Because that kind of gives way to me actually seeing, all right, smart money is showing their hands at this key level. All right. So positively correlated pairs like Euro USD, Pound USD, right? SPY and NAS 100. Just to give an example, right? If EU makes a high and then runs out that high, right? Let's say this is EU. Then the anticipation is that GU, right, should also do the same thing. All right, now let's say these guys are both headed into an array, or maybe they're already at key levels within their own respective nature. All right, let's say that EU runs out its previous day's high, right? It doesn't always have to be a previous day high. It could just be any regular swing high, swing low. But EU runs its level out. GU, however, runs up, fails to take out its high. We see an immediate rebalance here. We start seeing lower time frame imbalances and lower time frame things that would prompt us to want to take entry. So maybe we start seeing that swing high fractal here, right? We're probably looking at GU. We see that same swing high fractal here, right? It's just that we didn't take out the overall high, right? So in that case, what that signifies, it signifies that smart money is showing its hand, right? It's telling us, cool, this area that we've already anticipated to be a catalyst in price is actually, it's actually manifesting as we'd anticipated. All right. And the biggest question for those that are new to this concept is, well, how do I know which pair to trade? All right. It's not a matter of knowing which pair, because I've never seen EU drop off and GU not do the same. All right. So it's just identifying the crack and correlation, and then you go in and you put the smaller pieces together, and it doesn't really matter which one you trade. All right. Negatively correlated assets like DXY and EU, right, would be just the inverse. If EU goes here, right, fails to make that lower low, stood before the expansion. All right, so this is EU. And then we have DXY, obviously trading higher, and then for some reason, we see DXY go here, and we start to see an immediate rebalance of that range, this is smart money showing its hands, right? And once again, doesn't matter which one we trade. Not EU, we could say, hey, EU is showing weakness, so maybe I want to go and trade EU because it's showing weakness. But obviously, we can't trade. We don't trade DXY anyway. But you guys get the point. All right. Assets where this happens a lot is like if I'm trading NAS on a daily basis, there's no way I don't have SPY pulled up, because you'll see cracks and correlations all day long. All right. So just looking at a few examples. Here we go. All right. So this is a chart of EU and pound USD. All right. This is a 4-hour chart, I believe. All right. But we can basically compare this high and this high, right? We're seeing EU take out that high. We're seeing we're seeing GU not take out that high, right? Cracking correlation leads to a huge sell-off in price. Same idea here. Here's EU. This is actually last week. We'll just take it to a real chart. So we'll go to the 4-hour chart. So all of us, we understand that last week we were inside of the key levels. This whole area up here, we were speaking about this area. And then inside of that area, what we saw was a cracking correlation. All right. So that cracking correlation is kind of supporting our idea that price should be ready to turn around. All right. So that's GU. And when I'm using this tool, I like to actually pull up the candles instead of just seeing the line. So we can go to a 15-minute chart here. All right, so Thursday. So here's Thursday's price action as we're inside of that key level. Right, we can see Wednesday's high is not taken. However, EU actually takes Wednesday's high. Cracking correlation, right? Creates that high resistance signature. This is the bottom of the range for EU and GU right here. So if you guys look down here, this is a couple of weeks, or not a couple of weeks ago, but actually I think just 2 weeks ago, where we're speaking, hey, we might get a short-term retracement in price. All right. Well, what supports that idea? We start to see a cracking correlation, right? This is smart money showing its hand. All right. Previous day's low taken out here. Previous day's low not taken out. All right. We go down inside a lower time frame. We start seeing lower time frame sell side imbalances negated, right? And there's other, ideas. Once you guys learn Model X, you know exactly how to execute within this area right in here with precision. All right, let's see if there's any other example. All right, then I think there's 2 examples of NAS. Okay, so if we look here, we have where is it? Yeah, this low, right? And obviously that low, we zoom across price. I can't get the line as straight as I want it, but that low is tapped, right? You can see is obvious cracking correlation here. We'll move down to this one. You guys take your attention to this level. Right, same idea. All right, cracks and correlation. All right, that's SMT. All right, well, we're gonna save institutional order flow for next week. All right, let's talk a little bit about high and low resistant liquidity runs. All right, now this idea is it sounds like super advanced. It sounds cool, but it's actually not. Like it's not a deal breaker. Um, it's just an additional viewpoint to have, or just a concept. But a high and low resistant liquidity run, right? Framing what's a high and low resistant liquidity run has it's basically two main disciplines. Okay, that's understanding current state of institutional order flow, right? And then also understanding the least path of resistance. All right. So for one, when I'm saying understanding institutional order flow, that's saying, hey, understanding what side of the curve am I on. All right. And everything will always point back to this, right? You have to understand where you are or what side of the curve you're on. If I'm on the buy side of price, right, then primarily if price is reaching up to an array and that state of order flow has changed to bullish, these highs are going to be what we reference as low resistant liquidity runs, right? To a certain degree, what this means is trade with order flow. That's basically all it's saying. All right, trade with the current state of institutional order flow. All right, because price is going to have a much harder time trying to reach back and take out this level, at least until it reaches up into those higher time frame levels. Right, that becomes a low resistant liquidity run. So you're taking this trade and you're anticipating a low resistant liquidity run back above that high, right? So price is going to be more prone to create new highs than it is for making new lows. All right. And in the event that it has, let's say it has this high resistant liquidity run, right? When high resistant liquidity run occurs, right? If price moves back into its current state of order flow, it's going to seek a low resistance signature. Right. So once again, if a high resistance signature is taken, right, but it's in line with order flow and we haven't really met the array, right, or had a turning point, it's going to seek a low resistance signature. I'm going to show you guys examples of that. All right. And the other discipline is the least path of resistance. All right. So if I'm looking at this point in price, I'm going to take you guys to some examples that we had for GU a while ago. If I'm looking at this point in price, let's say this might even be a daily time frame. All right. And I'm looking at this range. All right. And there's not a lot of basically the delivery is one direction. All right. This would be the least path of resistance. All right. At least up until we get to this area here, which would be considered a high resistance signature, right? Odds begin to fall off. All right. But if I'm taking a trade up here, right, this would be a low resistant liquidity run, right? There's not a lot of noise or there's not a lot of lows to be traded through, right? Or things to possibly give price a reaction, right? Because we understand that every time a low is taken, price can give some type of reaction. It can consolidate, move around, right? But if there's not a lot of trading within that area, and not necessarily trading, but if there's not a lot of back and forth within that area, right? Then we're going to consider that a low resistance signature. So I'll take you back to before we look at the EU examples, let's go to GU. And I'm going to give you like the thought process and framework from a while ago. So let's go to weekly chart. All right. So I want you guys to look at this area right here. All right. All right. So just the price action in between here. All right. We were framing a draw up here, and we understood that this is what's going to be a fun time to trade. Why? Because there's not a lot of resistance. There's not a lot for price to react from. There's one-sided delivery. All right. So we're calling, hey, low resistant run through to that level. All right. So that would be a scenario where that becomes least path of resistance. All right, a low resistant liquidity run. right? So whenever you guys see those, you see price action that is primarily like one directional and there's not a lot of back and forth going on, right? You can anticipate those low resistant runs. I think there was another scenario over here on GU, right? Especially like seeing areas like this. And obviously this is an hourly chart, right? But if I were to zoom out, this would look just like one directional delivery. I'm not sure if we run through this level also. All right, so we haven't made it through that level just yet. However, this level here, right, we saw, right, that was pretty much a low resistant liquidity run. So that understanding of low and high resistant liquidity run, it's not a complete deal breaker. All right. However, it does pay to understand, hey, I'm trading with institutional order flow or I'm trading against institutional order flow. Price is gonna have a hard time running back above a certain high or back below a certain low. All right. So let's go back to the EU. I literally deleted it. All right, cool. All right, so this area here. All right, I have someone that needs to mute their mic. Yes, I have questions. All right, cool. All right, so you see here, right? Obviously, we understand that order flow is bearish from a higher time frame, right? Basically, what I mean is we look at this daily chart, right? These up close candles are primarily supporting the direction of price. And we'll have a in-depth lecture on this next week once we talk about market maker buy and sell programs. All right, order flow is bearish. Okay. Now we've had basically this area here, right? And any trading back above would be considered a high resistant liquidity run. All right. So right here, this is a high resistance signature. We've taken out a high resistance signature, right? Now price is seeking low resistant liquidity pools, right? Let's look at another example. We could consider this example also, but there's another one up here. All right, this is from a while back. All right, we're on the sell side of a curve. Price is here. Boom. We take out a high resistance signature, right? Price moves back into seeking out, right, a low resistance signature. So we're going to have that low resistant liquidity run, right? Low resistance signature, low resistant liquidity run, right? We've taken out a high resistance signature. Here's another example here. High resistant, we're on the sell side of a curve, right? Price has a high resistant liquidity run, right? Look at this. We take out this high on a lower time frame. That wick, that means there's an immediate rebalance. That's why you're getting that wick. All right. That immediate rebalance on the sell side of a curve. Let me zoom in. You guys probably can't see this clearly. On the sell side of a curve, we have that high resistant liquidity run. Price is going to seek low resistance signatures. Right. Boom. We will have an example. Right. Now, one thing to mention in terms of high resistance signatures, we have to understand that this concept is fractal. All right. So if I'm looking at a 15-minute chart, right, this any downward move would be considered low resistant. But then if we zoom out, we understand that where we are from a daily. So we may see this as a high resistant liquidity run. Now, if I'm looking at this 15-minute chart and I'm saying, all right, well, shit, any downward movement is going to be high resistant liquidity run, right? As you can see, price is more prone in this market right now to take out highs, right? We've been more prone to take out highs, okay? Now, time and price. What do we see last week? As price moved up right? And we were like bullish, right? But as we moved up into those higher time frame arrays, this is time and price, right? It's not random that we run up into a higher time frame array the day of CPI, right? So when price wants to take out, right, high resistant signatures or high resistant or have a high resistant liquidity run, it's going to use a volatility injection from news to do so, right? This CPI release, boom, takes all of this out. All right, now we're on the sell side of that curve, getting ready to complete this market maker sell model, right? Or at least that's what we anticipate. Okay. Last little sidebar, this bonus for this lecture. We're going to take a look at indices, right? Intro to voids, right? We're just going to go into the full thing. All right, so when we're saying time delivers price, all right, I know that term gets thrown around. Time delivers price. All right, what that means is, right, price is basically price is moving in such a manner that's going to align with I guess with an event that is based on the premise of time. Okay. Just like last week, right? That event here, right, taking out those high resistance signatures, right? Price purposely ran into those arrays up into the point of Thursday. Right. That's time delivering price. Now, when we're looking at indices, you got to really understand the components of trading that, because when you're trading the index market, that those are factors of the New York Stock Exchange. All right. So then you have to take that and then you understand, right, the elements of the New York Stock Exchange. All right. So the that market runs from 9:30 a.m. to 4 p.m. EST. All right. At 4 p.m., that is to some degree like after hours trading. Right. So RTH, real trading hours, 9:30 to 4 p. And then 4 p, there's a small window of like after hours trading. All right. And then you have ECN, which is electronic communications or something of that sort. You can look, but you can look this stuff up. This is not anything made up. All right. And 4 a.m. Through to 9:30, that's kind of like a pre-market, right? So some brokers will allow pre-market trading. All right. But at a certain time where orders are actually executed, which I think is that the executions don't really start to about 7 or 8:15, I believe, or maybe CME. However, we're taking the understanding of those time windows and primarily 1600, 0400, right? 1600 being 4 p.m. EST, 0400 being 4 a.m. EST, right? We're understanding that that window of time, right? This window of time is a low liquid period, right? It's a void. It's almost like it doesn't really exist. All right. Now, if that period of time, right, or price doesn't really exist, right, then that means that time delivers price, right? It's going to want to make up for what doesn't exist. So if this is 4 p.m., say 4 p.m. is here. All right. So the 4 p.m. opening price is here. Price begins trading. Then this window, right? Here we are. Boom. And now this is 4 a.m. Okay. Before we got to 4 p.m., right? This was the market. Market closed. 4 a.m. Boom. Let's consider this time window of price doesn't exist. So what needs to happen? Time needs to deliver price. Time, right, or price needs to fill in this void, right? So I'm going to show you guys, we're going to look at a few examples here, and then we'll go to NAS 100, right? And we'll just see if there were any occurrences in the previous weeks, and there's usually an occurrence. All right. So basically, what's going to happen is we're going to understand that the draw is literally 4 p.m. All right. So just remember it like this: 1600 is always the draw. 0400 starts the origin of the draw. Right. So I'm looking at these examples here. The opening price, this purple box, is 0400. This price here on this candle, I'm sorry, this is 1600. All right. The opening price on this candle up here is 0400. Right. And there's a disparity between those two opening prices. We understand that the draw is 4 p.m. It's not random that price gets to 4 p.m. Has a little, razzle dazzle, and then it continues. Okay, let's look at another example. Okay, so this is how your eyes should picture this. All right, here is 4 p.m. There's 4 a.m. Right, you can see price running right to that draw. Here's an example here. Now it doesn't happen. This one right here just doesn't happen in the same day. However, we understand there's a void between this from this opening price to this opening price, right? Price draws back to fill in that void. All right. You can look here also. There's 4 p.m. There's 4 a.m. Look at where we're running to. Take that opening price, right? It's not random that price is responding from that point. Right? Here's another example here. We'll take the opening price of that down close candle. Right? That precision with bodies is not random. Okay. This would be 4 a.m. Short-term low created, intermediate. Right? This is engineer, neutralize, distribute, rebalancing the range. Short-term, intermediate, short-term. Right? Price begins to get away. Where is it drawn to? 4 p.m. Right? Same idea here. 4 a.m. 4 p.m., 4 a.m. We open, boom, we're trading right to this opening price, right? It's not random that it responds to that point. Okay, so let's go to, let's take a look at NAS 100. And then we'll just look at the previous week's price action and see if there were any examples. Yeah. All right. So this is last Thursday, 4 p.m., right? 4 a.m. Let's consider that that area does not exist. Where is price drawn to? Boom. Right? Uses the 4 p.m. price as a point of resistance or support. Right? Small ranges. Small range here. All right. Here's an example. 4 p.m. 4 a.m. Price running to that point. Right. Not a random occurrence. Right? We've had more smaller ranges than I'm used to seeing, but here's an example here: 4 p.m., 4 a.m. Like when you see days like this where we open up at 4 a.m. and price trades even further away, then you align that with maybe a previous day's high or something of some sort of that sort, and you see, hey, I know where the draw is, right? Tom is going to deliver price. We're drawing back to that 4 p.m. opening price. All right, this stuff in here, we're going to imagine that this stuff in here doesn't really exist. Only thing that exists is that 4 p.m. opening price. Same idea here. That candle, right? That is not random, right? So this day, now, this day here, I want you to look at what happens. So yes, 4 p.m. is up here, 4 a.m. is here. We don't go to it. Now, it's not always going to happen, all right? But probably 90% of the time it does happen, okay? But what I will challenge you to study we get deeper into the study of this, there's a lot of delivery within here before we even make it to 4 p.m. All right. So do we really need to fill back in that area? Right. Same ideas here. This price right here. Look at where the day stops. Look at this. That's 4 p.m. previous day, 4 a.m. the new day. We trade further away, running into buy side liquidity pool, right? Failure swing. Okay. Failure swing. Where's price drawing to? 4 p.m. 4 p.m. opening price, right? So that concludes the or my part of the lecture in terms of teaching. Now we'll open up for questions. Right. So any questions that you guys have? I saw you guys had a lot of questions in the chat, so don't be shy as we're on the call today.
Can I ask
No.
something going back to lecture one?
Yes, sir.
I just wanted to ask about the ceiling range. So for phase three, the rebalance part, if it breaks through the engineering side, but hasn't broken through the initial neutralized part, can we still say that it will be a valid trade? If it goes beyond the engineering area, can we say that that's probably a low probability to take a trade on that front?
So we engineer, right? And you're saying we've traded here. And can you
Yep.
give me the rest?
Then you distribute downwards, and then when you rebalance back up,
Mm-hmm.
this rebalance, if it breaks the high of the engineering area, so it goes over the 50% and to the top, but it doesn't break the very top part of the neutralized area.
Oh, here. Yeah.
Yeah, exactly. Can we
Mm-hmm.
still say this is valid, or do we invalidate that because it's well over the 50% plus the engineering top?
Yeah, that's a great question. So you can obviously, right, this is still the range. This would be the range that we're playing in, right? Now, I wouldn't want to see it come back above this point. All right. But we got to understand there may be scenarios where this little initial range isn't really just a tight range. It may be something like this, right? So but in those scenarios, to not confuse you on this, just understand this is the range. This is the current range that price is playing in. This is where I'm going to look through my PERA matrix. All right. So price may move to up to 79% of this range, right? That OTE level. All right. There may only be an order block at this top of the range, or maybe just a rejection block that price responds to. All right. But in that case, it's still a dealing range. It's a bearish dealing range. And you could look for that delivery to form right? But then you also want to be mindful of, the inefficiencies that were in here. Did price invalidate any inefficiencies and things of that sort? Because you might get a slight reaction and then boom. All right, but it's not going to be one form-fitted answer for that scenario, because obviously there's different frameworks at different times within the market.
Cool, thank you. My other question was about swing points that I asked in the question channel. How do we determine how to fix the swing A to swing B? Because sometimes there is a swing within sort of the swing of the larger swing of A and B, and how do we pick which one is better for the OT or entry?
Yeah. So you're never going to completely know, right? Because, and that's a great question. So if you look at this range, right? Let's say we pick this range. This is actually a great example of what you're asking. So I think what you're asking is, if I were looking at this whole price swing, how would I know where to measure from? Is that what you're asking?
Yeah, because in the mini series video, I see you picked two areas. You had the original A to B, which you're kind of demonstrating now, and then you had another swing point within that, and you picked the one within that rather than the large range for the OTE area. So I was just curious how.
So basically, obviously, like this is the overall parent price swing. All right, this whole price swing. Okay. Now, when it comes to knowing which swing point to choose, I will be honest, there is no real objective answer, because you never really know. All right. But for us, we really shouldn't care, because the significance of a range to us is looking at PD arrays and allowing price to trade into the array and seeing if we get a certain delivery that tells us it's turning around. Now, let's say we don't have that understanding yet. I'm going to take, if this is my range, right? And let's say price creates this little swing high right here, the swing high fractal inside of that range. I'm going to study this part of the range first. Why? Because that should be a high resistance signature, right? I really shouldn't see price run back above that area. So then this point here becomes my point of focus. But I'm mindful that this is the overall parent price swing. So in any event that price rallies higher and we don't necessarily see a change in order flow from here, and we run this portion of the range out, then I have to just refer to my parent price swing, right? Price might have just referenced that as an old high, right? In relation to the parent price swing, all right? Just as we see here, right? So we liquidate that high, and then boom, we're starting to trade lower. Does that answer your question?
Yeah, thank you.
Okay. So I think for me to shorten it up, I know I speak a lot, but it's take the swing. Like this, if there's a range and within that range there's a swing high like this, take the swing point. All right. And the reason you're doing that is because that swing point, that swing high, right, that took out a short-term high here, that's a high resistance signature. So basically what we're saying is, all right, cool, this area should hold up. I want to see price, turn around from this range.
And apologies, I'm still trying to wrap my head around this high resistance and low resistance. Are we saying high resistance meaning there's more swing points within it, and the low resistance ones has less swing points within it?
Yeah, so high resistant. Let me go back to this image. So when I'm saying high resistant, just think about a liquidity sweep. High resistant, there was a sweep. Low resistant, there was really no sweep before the move away. All right, so high resistant, boom, price swept, got away. Right here, you see that short-term high? Swept, got away. So if I'm looking at price, I'd say, hey, well, shit, I don't really anticipate that we would run through that level. So I'm gonna first focus on this range. All right. So notice the difference between this sweep, move away, and this low created, move away, right? Low resistance. You see that? Boom, price runs right through that level.
Could I simplify that further to say, like, the high resistance is basically having a breaker, and then the low resistance is a mitigation?
Absolutely. Absolutely. Well
Cool.
put.
Thank you. Thank you.
Yep. Yes, sir. Great job. All right, next question. Please do not save your questions for the chat like throughout the week. That's the worst time to ask in-depth questions. This would be the time. Whatever questions you had last week, or even from this lecture, like please ask away. To answer this question here, that 4 p.m. to 4 a.m. That's not the silver bullet thing. I haven't really dove into that whole silver bullet idea.
I had a question about correlation. From the previous slides, you mentioned NASDAQ and S&P 500. If we were to trade Dow Jones, would we also correlate that with S&P 500, or we correlate that with NASDAQ?
Well, I would say NAS, but honestly, you should be able to look at either of them. I find that there's a higher correlation with SPY and NAS together. However, US 30, because they're all basically compiled of Fortune 500 companies within the New York Stock Exchange. So to some degree, we should be able to look at any one of those assets. I'm trying to bring US 30 up on the chart for you. Right. 15-minute chart. All right. So here's an example here. So you can see previous day high right here. Right. We don't take that high on Wednesday for Dow. And then if you look here, right, opening bell, we take that high, right? And then what happened? Right, we fall off for that day. Okay, same idea right here. Okay, you can see this whole period of time here is liquidated. Then once we look at Dow, no liquidation. Right. So I guess this is kind of answering your question or proving the point that yes, you can use it. You can use Dow and NAS or whichever you choose. I just in my studies I found a very high correlation between S&P and NAS, but obviously there's a correlation between Dow and NAS as well. And if this is correlating with NAS, then obviously it would be correlating with SPY. Does that answer your question?
Yeah. Thank you. And then for the 4 o'clock theory that we're just talking about, is that purely only applicable for NAS, or can we apply that for all US indexes? And we can't apply it for FOREX, right? Because obviously there isn't that 4 p.m. to 4 p.m. AM closure.
You will see instances of that in the Forex market. However, I'm not saying you can't use it, right? You can see instances of it. However, I'm not preaching to use it in Forex, because the logic behind it comes from the elements in terms of certain like time events that are relative to the stock exchange.
Cool. Thank you.
Yes, sir. All right, let's go to 4-hour chart, daily chart on Euro. And just this is just looking at swing highs, swing lows. All right, seeing short-term low, right? Intermediate, price rallies higher, we start negating inefficiencies. All right. And you start seeing we've run this level right here is occurring from reaching a quarterly inefficiency, right? If you remember from lecture 1. All right. So right here. Okay. So now let's go back down and apply the understanding. We see short-term lows being created just above. We rally down, right, into the array. Price trades off of that inefficiency. We start negating imbalances, and we start anticipating that other short-term low. All right. And you'd anticipate it, right? Or have the sense that it could occur, right? But obviously bearish dealing range, bearish order flow. All right. But when you start seeing certain things down here, and I can zoom into this area, you'll see short-term low, intermediate, short-term, right? But I'm just showing the fractal nature of this whole idea. All right. So let's zoom into that area. Go to an hourly chart. I remember this whole move. This was literally CPI. This 8 o'clock. This 8 o'clock candle. This was CPI a long time ago. Right. All right. So you can see here, short-term low is created. Intermediate price rallies away. What's the anticipation? I need another short-term low. Right. Completes the swing high fractal, swing low fractal. Boom. We rally higher. We come down. Short-term low hovers above the array. What's the array? Old low. All right. CPI takes us down into that short-term low, right? We rally higher. Short-term low here. Intermediate, right? What's the anticipation? The other short-term low. All right. Boom. Rallying higher. Okay. All right. Hang on 1 second. My daughter is literally at my office door. All right. Okay. All right. So we saw this level, right? This is also a daily range. All right. So when we're looking at and we're having those anticipatory skills and we're looking at short-term highs, short-term lows, and things of that sort, we're that all blends into that whole dealing range idea, right? Next week, you'll see how it also blends into understanding market maker buy and sell programs, right? Because we see this as a smart money reversal, that first low risk buy, offset reaccumulation. But what happens here? Even what happens in the offset reaccumulation? Short-term low is created, intermediate term low. All right. Well, what do you think is what are you anticipating over here? Let's slide and see the other short-term low, right? Right. What else do you see? Daily range. What else do you see? Breaker. Right? Putting the pieces together. Now, even here, you're going to see the same swing low fractal. Okay, it continuously repeats over and over and over and over and over and over and over again. So let's zoom into here. We're understanding that we're inside of a breaker, right? We're inside of it. This is also a dealing range. We've created an intermediate term low. I'm trading this. My mindset says, hey, I'm anticipating that other short-term low. I have an inefficiency here, inefficiency accompanied with breaker, right? Highly probable area. I'm going to zoom inside of here and let's pretend we're trading this from an intraday perspective. Let me move this off of the chart. All right. So if I'm trading this intraday, I'm looking at price action. All right. We trade down into here to that inefficiency. But look at what's happening on the lower time frame. You couldn't see this when we're zoomed out. But look at what's happening. Price comes down, short-term low. Takes it out, intermediate. What happens? Market structural shift. Imbalance is negated. What happens after market structural shift? Retracement, right? We retrace, boom, expansion. All right, cool. What signature is this? Failure swing. Where's my mitigation block? Right here. There's a mitigation block, right? What also can I see within this? Daily range. 1, 2, back inside the range, boom. Right? And when you zoom out, it all makes sense that that should happen. Why? Because I'm seeing the swing low fractal. This was phase 3 of the overall daily range. 1, 2, right? That was phase 3. Price is engineering stops, neutralizing, right? We're getting away. Anybody have any questions or objections to that? Right? And then also what we're seeing is now these highs are becoming low resistant liquidity runs. So every time we're buying here, right, we're buying in a low resistant liquidity run. All right, price is more prone to take out highs. If you were shorting here, you'd be shorting high resistant liquidity run. Why? Because price is protecting, right? There's more interest, institutional interest to protect these levels. Right? Why? Because we want to see higher prices. And then if you were to zoom out on this, if you remember from the first lecture, right, we took out 4 failed to take out 2. We went through phase 3. So now we really understand that we're attacking that level right here. All right, NFP wasn't here. Let's go into this area and just see if there's anything to derive from this. That's 830. Yeah, this was NFP a long time ago. Right. So not the prettiest price action here. You can look at the top of this range and just see short term, highs are taken, intermediate, right? You can also see this as a dealing range, short term, intermediate, anticipation is the other short term. All right, even inside of this, that same swing high fractal forms. Short term, intermediate, what's my anticipation? The other short term, right? Inefficiency, what can I view this as? Breaker, up, down, right? So if I go to a lower time frame, we'll see that breaker, maybe even a 5-minute. There you go. Okay, and remember, when I'm going to lower time frames, as mentioned earlier, I like to see that breaker. This is a short-term low. That's a low on that candle. Price goes higher, lower, taking out that short-term low. So that, you can see the reactions from that order block. Boom. We clear it out. Price trades back higher into the breaker. But even still, guess what forms? Short-term highs, intermediate, short-term. If we go to a lower time frame here, guarantee you there's inefficiencies in there that are negated. 2-minute chart, right? Bingo. Short-term high, intermediate. What happens? Once we get the intermediate term high, price says screw the imbalances. Market structural shift, retracement, creating what? The other short-term high. Swing high fractal complete. Price trades away. All right. So we're going through this because what you guys have not realized yet is this is a key component of the entry model. All right. So it's just getting you to get into habit of realizing that this is the A plus, right, delivery of price. And it gives you a degree of patience. It gives you a thought process that says, hey, you need to be patient. That's the very first swing point, right? You shouldn't take that. Right. And if you take it and you get it wrong, at least you know why. Oh shit, I didn't allow price to engineer liquidity. That was a short-term high. I should have waited. Right. Cool. So all right, guys, if you guys don't have any questions, we'll end the call there. Next week we'll see how this understanding blends into us understanding market maker buy and sell programs. All right, understanding redistribution, offset distribution, reaccumulation, offset accumulation, or offset reaccumulation. You'll see how all of that, like this here, this could be seen as the smart money reversal point of a market maker model, right? Every other point, offset redistribution, right? Short-term lows created. Right. All of what we've talked about up to this point, right? Next week, we put an additional piece together. Then we go into bias, and then we go into entry model. And then we start putting together trading plans and things of that sort. Cool. All right. Thank you guys for your time. We will see you throughout the week. We'll have a weekly outlook that will be uploaded later on tonight. And then we'll get that quiz to you guys. And then also you guys will have that Q&A session with Vision this week as well. And also, I want to give you guys a personal apology. There was a mix-up this week in terms of the psychology session for you guys. I know you guys were anticipating that. So it should be rescheduled at this point. Claire and Matthew have worked it out. But I just want to also give a personal apology to you guys for that. So with that said, let's have a great week. Let's get 1% better, and let's just keep putting these pieces together. Thanks.